Welcome to Flight Academy Module 2. And me that will be taking it, I am Andrew Mamus. But my full name is Akwegu Andrew Mamus, but you can call me Andrew Mamus for short. In this Module 2 challenge, we are going to look at a lot of things which I want you to know. And one of them is micro risk. So what is micro risk? What is micro risk? Macro risk is a type of political risk that impacts all asset classes exposed to a particular country or region. It affects any class exposed to a particular asset classes that is exposed to a particular country or region. So let me clarify. For example, you elected a government opposed to foreign influence and interference. Like, for example, in Nigeria here, we have the ban of foreign rice. So there are companies outside Nigeria which do really supply rice to Nigeria. They have a warehouse here in Nigeria, whereby they supply the rice to, they produce them in their country, then they bring it down here. But since the ban already, that is micro risk. Since the ban, the business cannot be able to continue. That is one example of the micro risk. So micro risk can be in two nature. One is being political or is being caused by microeconomic factors outside of government control. But at times it's basically on political reasons most times, such as the ban of TikTok in USA and the ban of America apps in China. Then, so that you can see from the explanation that we have seen what micro risk is, but there are other things I want you to know. And what are the causes of micro risk? What really causes micro risk? What causes micro risk are one, unemployment rate. Unemployment rate can affect micro risk, and interest rate also is another factor to consider. Exchange rate is another factor to consider. Then commodity price is one of the major things you should consider also. It also affects macro risk. So since we have looked at macro risk already, but we have to look at one thing about micro risk, which is how does company manage their loss from micro risk? Because a company who have done research and found out that this particular country they want to invest money more, or they want to bring a startup in, has some micro risk. How does companies manage their loss from micro risk? What they do is that companies can guide against micro risk by purchasing political risk insurance to mitigate potential losses. So that's what the companies does. So now let's move to foreign exchange risk. What is foreign exchange risk? Foreign exchange risk refers to the losses that an international financial transaction may incur due to currency fluctuation. When the currency is fluctuating, automatically there might be some losses that will be incurred doing a foreign exchange. So it's a big risk, and also it's also known as currency risk, FX risk, which is forex exchange risk, and exchange rate risk. So it describes the possibility that an investment value may decrease due to changing relative value of the involved currency. So foreign exchange risk can also affect investors who trade in international markets and business engaged in the import and export of products or services to multiple countries. So before I go further, we have three types of foreign exchange risk, and one of them is transaction risk. This is the risk that a company faces when it's buying a product from a company located in another country. So let's say, for example, you want to buy, let's say, like Nigeria now, we don't produce most electronics, and you decide to buy an electronics which has in terms of yen. So looking at the current price of yen and that of naira, let's say, for example, the cost of the product was 20 yen, but due to between the time of transaction, let's say one more time, you're supposed to, let's say, 1 naira is equivalent to 1 yen, let's say, for example. But at the end now, you find out that the value of naira have fall down, have devalued. So automatically, you are going to pay more in terms of naira compared to the one you're supposed to pay before. So transaction risk comes in. We have translation risk. A parent company owning a subsidiary in another country could face losses when the subsidiary financial statements, which will be denominated in that country currency, had to be translated back to the parent company's currency. We have economic risk, also called forecast risk. It refers to when a company's market value is continuously impacted by an unavoidable exposure to currency fluctuation. So now let's go to regulatory risk. Regulatory risk is the risk that change in laws and regulation will materially impact a security business sector or a market. So, and it's why often necessary for the public good. Government regulation can increase the cost of doing business or limit the prospect for further growth, calling to profits and halting the return on investment. An example of such regulation is the recent temporary banning of Twitter from Nigeria. So that alone have really affected most tech giants because of one, insecurity, and other factors they consider making the government to bring all this regulation in. So, example of a regulatory risk is one sector faces significant regulatory risk in the area of antitrust enforcement in big tech. I told you about Twitter in Nigeria. I think Facebook wanted to be included there, but I think they were not included. So we have the issues of Twitter, and up to now it has not been resolved. So regulatory risk versus compliance risk. Regulatory risks are the risks. You have to understand that they are the risks that they can come. They are laws that they can come at any time. But compliance risk is another thing again. Compliance risk is a risk that a company will have been determined to be in violation of already established laws or a regulation. These things have been there already, but most cases that you didn't check properly. So you fall victim. You fall victim for this law, so and you have to pay heavily for it. So that is the end of this course. See you next time. Thank you.